Ladies and gentlemen, please welcome Jason Schenker.
Thank you all very much. It is a pleasure to be here today. We're going to talk about navigating the future. I know there are a lot of pressures out there, but I really want to talk about the potential for this industry and where we are. The most important things that I see right now is quite a bit of good news for material handling. And we can see it in the monthly MHI BAI data. I hope you all are getting this data series. It's based on survey responses from the executive committee and the roundtable. And you can see that for the last 13 months, we've seen expansions in business activity. For 12 consecutive months, we've seen expansions in new orders. And in the most recent month, there were expansions across most of the series. So overall activity, new orders, shipments, as well as in future new orders, which have now expanded for 39 consecutive months. So it looks like a lot of the worst is behind us. You know, if we look at new orders, where we've been, the blue dots are the monthly, the red boxes are 3-month moving averages. You can see we've turned a big corner in the last 12 months. Things look good. On the right-hand side, you can see shipments. And the shipments numbers, those have been positive. Not as positive as new orders recently, but that's okay because new orders lead shipments. The second thing is shipments remained consistently positive in the last 3 and 4 years, even though new orders at times contracted. And that's because in the wake of COVID, there was a backlog that was burning off. Unfilled orders, those have been weak pretty consistently in the wake of the post-COVID period throughout parts of 2022, 2023, and 2024. And inventories, which have fallen for most of the last several years. And that's because there was such a big buildup during COVID. And of course, if we look longer term out, the future new orders series, very positive, right? Expanded for 39 consecutive months, right? And you can see there's been a little bit of a slowing. The green boxes are 6-month moving averages, but you can see things look good. What this measures is whether there's an expectation, whether future new orders 12 months in the future will be higher than they are now or lower. The vast majority still see a very strong outlook. And a lot of this data looks really good. Moreover, compared to other manufacturing data out there, material handling looks really good. If we look at the ISM Manufacturing Index, a broad-based survey of purchasing managers in manufacturing, it's below the break-even of 50. The data we just saw in the MHI BAI looks significantly better than that. And if we look globally at PMIs for manufacturing, you can see a giant mountain in the post-COVID period immediately after when interest rates were so low, big boom, and then a collapse after interest rates went up. The Russian war on Ukraine caused a lot of inflation, interest rates went up to tame the inflation, and orders fell off. Now, as interest rates are beginning to fall, you can see these numbers moving back to flat. And in September, for the first time in 37 months, this series was just barely back above the break-even. Whereas for the last 12 months, new orders have expanded in this business. So material handling looks really good. If we look at the MHEM forecast, which, by the way, a full deck, for those of you who attend the quarterly call, there's a normal standard deck that will be posted to the MHI Solutions page after the conference, which includes all of the forecast data you normally see. This is an abbreviated discussion of that data, but the outlook is really good. And by the way, for those of you not attending the quarterly calls, please attend the calls. We go through a regular update of how the outlook is. In 2024, you can see red numbers there, pretty big contractions in new orders. We saw that reflected in the MHI BAI, down 19.2%. This year, slight contractions likely, but let's look forward, 2026, 2027, 2028. Those years all look good. By the way, this data is extremely flawed, and I'll talk about how in just a second, which is why we created the MHI BAI. The revisions to this data can be massive, which drastically messes with what the forecasts are going to be. But the outlook for the next 3 years, new orders and shipments look good. Why? Lower interest rates, reindustrialization of the US economy, all of those things are very positive for this business. When we look at 2024, 2025, again, last year, based on the government data, which isn't a pure representation, by the way, of this industry. Only some industry groups are in here, and then there are other categories that are part of the NAICS codes that aren't represented here at all, like elevators and escalators, which are part of this NAICS code. So it's not a perfect representation. The MHI BAI gives us a better read. And the reason I'm critical of this data is the most recent data revisions lowered the 2024 actual numbers by 23%. That's right, a quarter of the business we all thought existed based on the government data vanished. For shipments, similar situation. Those were revised down recently by 22%. Last year's number, a quarter of the business that everyone thought was there, poof, just gone. And that's not to say there's a current problem with data. This happens a lot, which is the very reason we created the MHI BAI over a decade ago. Something similar to this happened, and folks in the industry said, and I'm sure some of you remember this, were massive downward revisions. How can we know where the industry's going if we have this government data and a quarter of the most recent revision, like $10 billion that people thought was in the industry just wasn't according to the government data. Very different situation in the MHI BAI, which gives us a read on directionally where things are going. That provides and instills more confidence. And that's why over a decade ago we created this data so that we wouldn't have to have questions around the bigger revisions. Unfilled orders, those down this year, likely to be up the next few years, those were revised 15% lower. And inventories, surprising situation, those were revised 11% higher. Why? Government data revisions just are. But the outlook, that's the important part. And by the way, these kinds of revisions plague every kind of economic data, right? Jobs data gets revised. Oftentimes, when business is going up, the jobs numbers, payroll, monthly announcements, how many jobs are created, those get revised up. Why? Well, over time, you actually collect more data. And when you get more data in around jobs and the economy is going up, you get upside revisions. But when the economy is slowing, when you get more data in, you often get downward revisions. We look at the GDP outlook. These are our forecasts. The outlook for the next few years is positive. The unemployment rate we think is going to be a little higher next year, but because of additional cuts in Fed funds rates, we do expect there's going to be positive growth. We think inflation's not going to be back to the 2% level for a while, though, because there are different pressures, especially in the service side of the economy, which I'll talk about. But the outlook is positive for the overall economy. So the GDP outlook is good. The MHI BAI is good. Those things are positive. And there's other positive factors that are very specific to this industry. So if we're talking about the potential for material handling, I'm really excited because we look at e-commerce spend. The Q2 data was at a record high of $304.2 billion. It's never been so high. We look at e-commerce as a percent of retail. Remember, during COVID, when there was a record percentage of retail that went up to 16.3%, guess what? We're back to 16.3%. And it's going to go higher, potentially a lot higher in the next decade. And supply chain pressures have eased off. You can see the big bumps. This kind of gives you an idea of how much global supply chain pressure deviates from the average. The average is 0. You can see the two big humps in the graph on the right. One of those big humps is COVID. The other one is the Russian war in Ukraine. And you can see where we are now. We're pretty close to 0 right now. Not a lot of pressures, which is good, despite all the trade talk, which I'll talk about in a second. But as we think about the economic outlook, and I've already kind of given it away by talking about GDP a little bit, a big part of why the outlook is good is because the GDP outlook is solid. The most recent data showed GDP in Q2 was 3.8%. Now, a lot of that was trade distortions. In other words, in the first quarter, GDP contracted by 0.6%. The reason it contracted is because companies imported stuff to try to get ahead of the April 2nd Liberation Day tariff announcements. You know, a tariff announcement's coming, you try to get stuff imported. Well, GDP is how much stuff is produced within an economy. Imports are not produced in the economy, they come in. That actually, when you add in that number, you actually have to take it back out again. It wasn't made here. So that detracts from GDP. In other words, the more you import, the lower your GDP is going to be. Opposite situation with exports. Exports are made within a country and then exported, right? They're made here, that adds to GDP. So you have to reconcile those two things. GDP is consumption, investment, government, and net exports. In Q1, lots of imports. That's why we got negative GDP. But because all the stuff was imported in Q1, there weren't as many imports in Q2, and so that boosted GDP up. The most important number here, though, is under consumer spending. Consumer spending was 69.2% of GDP in the second quarter. Just to recap, almost 70% of our economy is people with jobs buying stuff. The most recent Atlanta Fed GDP Now number out just a couple days ago shows that the outlook for the third quarter is that GDP is likely to be 3.8%. Why? A couple things. One, debt delinquencies are really low. We look at consumers. Consumers do have a record level of debt, but that goes up over time, in part because it's the value of the debt and you have inflation. 4.4% was our debt delinquency of consumer debt in Q2. Put that in perspective, in 2009, 2010, it was almost 12. And yes, 4.4% is higher than it was during 2023, for example, but prior to COVID, this would be near the all-time record low for debt delinquencies. Plus, in the last 4 quarters or so, the reason this has gone up is primarily because of student loan debt delinquency and the end of student loan debt moratoriums. So this isn't mortgages. In fact, 68% of all dollars issued for mortgages since Q1 2020 went to people with 760 plus FICO scores. This graph shows the billions of dollars by credit score for mortgages. You can see on the left, there's a wide variety of colors. Those represent different credit qualities. On the right, there's a giant icy blue mountain of excellent credit. That's the 760 plus FICOs. Even in the most recent quarters, 67% of all dollars originated from mortgages went to people with 760 plus FICOs. By the way, we have some of the highest levels right now. We have record levels of people who own their homes outright without a mortgage. So not only do we have record numbers of people who don't have mortgages and own their house free and clear, you have the best credit quality in the mortgage market we've ever had. The economy, 70% is people with jobs buying stuff, which is why also foreclosures and bankruptcies are near record all-time lows. The growth outlook, of course, because 70% of the economy is people with jobs buying stuff, is also supported by jobs. The unemployment rate's gone up. You can see it in the left-hand side. The unemployment rate 2 years ago was 3.6%. It's 4.3 now. It's been going up. But it hasn't been going up because payrolls are falling. It's going up because people are entering the labor market and they're not able to find work. I'll talk about that in just a second. On the right-hand side, you see payroll numbers, and the number of payrolls adding has slowed. This is why the Fed is cutting rates. The Fed has a dual mandate. Their focus, full employment, low stable prices. They want to keep this going because there's a risk, if they don't cut interest rates to encourage the job market, that maybe we do get drops in payrolls. But if we consider where the unemployment rate is, I mean, it's lower now than it was at any time during the housing boom before the great financial crisis. This is a very low unemployment rate, even at 4.3%. And payrolls are at a record all-time high of 159.5 million. Yes, in the latest job report that we have access to, there were 22,000 jobs created in August, but there were downward revisions to the prior 2 months of 21,000 jobs. So net, this is only 1,000 jobs higher than the previously revised number, but it was still a record. The next job report is delayed because of the government shutdown, which I'll talk about in a minute. Not only, though, do we have record high payrolls and a low unemployment rate, but we have the second highest labor force we've ever had. In August, almost 171 million people in the labor force. And out of the 171 million people, less than 2 million are collecting unemployment benefits. That's only 1.1%. Now, the 4.3% unemployment rate is based on surveys of people. You ask them, do you have a job? If they say no, you ask them, are they looking? If they say, I don't have a job and I'm looking, they are counted as unemployed. Another way to measure unemployment would be who's collecting unemployment benefits, which is only 1.1% of the labor force. So if you're wondering why it's still tough to hire people, this is why. And there's over 7.2 million open jobs. Again, there's less than 2 million people collecting unemployment, which means there's 5.3 million open jobs more than there are people collecting unemployment benefits. But I know there's a bifurcated feeling in the labor market. People have this sort of split dynamic. Part of it is, if we look, the unemployment rate for recent college grads is up. It was 4.8% in June. It's going up. I wasn't always an economist. And in 1999, when I finished undergrad, I was going to grad school for the first time. I had the second dumbest thought of my life. And I thought the job market in 2001 will be even better than 1999. And so if I go get a master's degree and come out, job prospects will be better. 1999 was a very hot job market. And if you ask me why I'm an economist, it's because after that, right, second dumbest thing I ever thought, 2001, the job market felt a lot like now. Very specific job openings. I ended up waiting tables. And I became an economist to help other people kind of see through all of this so that hopefully other people wouldn't end up in a similar situation. And I remember at the time thinking, unless you majored in nursing, there really weren't jobs. And today, ironically enough, that's also true. There's almost 1.4 million open jobs in healthcare and social assistance. And if we look at where the jobs are being created, this is the monthly changes from August. Yeah, some categories are down a little, some are up a little. Again, consider this is 160 million jobs, and we're talking in the thousands. But only one category showed a significant number of job gains: healthcare and social assistance. And if we look at who the top employer is by state, we look back at 1990, dark green is manufacturing. The mustard color, which is now in 2024, that's healthcare. So the dominant top employer in almost every state right now is healthcare. If we think about how the work has changed, why it's difficult, healthcare is plagued by some of the same challenges that affect hiring in this industry. A lot of physically demanding in-person jobs, right? This is data from Robert Half. 83% of all the jobs in healthcare are fully on site. And that compares to a difference in how jobs are being posted, right? Where only 64% of jobs being posted today are fully in person. Those physically demanding in-person jobs are also in wildly high demand in manufacturing. Over 400,000 open manufacturing jobs right now. More jobs than were open in the space at any time between 2001 and 2017, I think. Lots of open jobs. oodles of open jobs. Construction, it came back down in August. I think we're going to get a bump up in September's numbers, but still almost 200,000, and that's with mortgage rates at 6.5. Transportation, warehousing, utilities, very specifically impacting this sector, 355,000 jobs. Look at the historical data. The gray bars are recessions. If you look at the 01 recession or the 07 to 09 recession, at any point, there were less than 200,000 open jobs in these sectors. And today there's 355,000. And wages have gone up across the labor market, which is good for GDP because 70% of the economy is people with jobs buying stuff and everybody's got a job and there's infinite open jobs in certain sectors and wages are up, people are making more money than they've ever made. That's all the good news. But from a profitability and a margin standpoint, this does present some challenges. It also engenders some inflation. But I want to point out two things, and I have an expectation around this. The first is you'll notice even during recessions, wages still go up. The second thing is, while recent college graduates are struggling, as I did in 2001, to kind of find their way in the world, those wages in professional services could end up being flatter or rising a lot slower now. Part of that's going to be AI, which I'll talk about in a second. But I think physically demanding in-person roles are going to see wages continue to rise. So you're going to get two sets of dynamics in the labor force. Many professional services roles, slower wage gains, more hiring potential. But if you're hiring manufacturing, warehousing, transport, healthcare, construction, all of that, physically demanding in-person roles, wages are probably going to go up faster. That's because, as an economist, I'll tell you, all markets clear. And I know it's an inelegant answer, but we're going to probably see that happen. Now, the inflation that we see from the high wages, that presents some challenges for the Fed, because the Fed has two jobs, dual mandate, full employment, low stable prices. Employment is full in certain areas, but it's slowing down in others. And inflation is nowhere near the Fed's 2% target. Because the government shutdown, the September CPI report has been delayed. But the Trump administration has actually called back into the BLS some of their workers to make sure this data is released before the next Fed meeting. The next CPI report will be released on October 24th. Next Fed decision is on October 29th. Our forecast is that headline and core CPI will be 3% each in the month of September. 3%'s a lot lower than the numbers we saw in 2022 or 2023, right? These numbers getting up towards 9%. But the Fed's target is 2%. And that's really important with the high debt load we have, which I'll discuss shortly. And for now, the Fed funds rate is between 4 and 4.25%. And if you ask the Fed members themselves, which they actually produce forecasts of where they think their rates that they set are going to be, this is what's called the dot plot. They expect by the end of this year, the mid-range to be 3.6. In other words, that the interest rate will be between 3.5 and 3.75. That implies 2 rate cuts or 50 basis points more from here. And then by the end of 2026, another 25 basis point cut. And then by the end of 2027, another 25 basis point cut. But this is all subject to change. Like all forecasts, past performance is not indicative of future returns. So the Fed can change its mind and often does. And as the Fed chair has very frequently said, the Fed is data dependent and there is not a preset course of policy. But regardless, interest rates are still lower now than they were a year ago. And they are elevated, but they are going down. So let's talk about some risks. There's a couple risks that I think we need to discuss. So that's the potential, right? Full labor market, looking forward, probably some lower interest rates. We have a lower dollar. weaker dollar, weaker interest rates, those are supportive of growth. Those are supportive for material handling and manufacturing. All of those things look pretty good. The demand for physical stuff not going away, right? Like, you can't AI the moving of physical stuff, right? We don't work in the metaverse, right? Stuff doesn't just show up magically, right? We don't have Star Trek things we can just replicate. So moving physical stuff is going to remain a very big, most critical part of the economy. So let's talk about these risks. The first is the government shutdown. The longest government shutdown was 34 days. Could this shutdown go longer than that? It's possible. I'm sure there are some betting odds somewhere on what it's going to be, but it doesn't look like it's going to end quickly. But we'll see how it goes. The one thing I will say is that it seems that the administration is very often outcome-focused and not process-driven, which is why you end up with push and pull around policy statements, for example, around tariffs or trade just over the last 36 hours, where something is said and then a different thing is said. All of this is pushing and pulling to get to a negotiation and a negotiated agreement. So we'll see. So there's the shutdown is one thing. The other thing, as I look a little bit forward, is, say, the political dissatisfaction with everyone. This is data from Pew Research released just last week. The light brown boxes show the unfavorable percentage, and you'll see that unfavorable percentages exceed the favorable number for all of our current leading politicians. So this is going to make for very interesting midterms in 2026. But this isn't unique because it's not just in the US where people are dissatisfied with their leadership, both Republicans and Democrats, right? You can see that across the board. There's political dissatisfaction everywhere, right? And if we look, this is the question of how much you dislike both parties in governing control. And you can see across countries, right? This is the question of, and the bright blue shows, who has a favorable view of a specific party in their country, right? And so a favorable view of neither party is the bright blue. In Greece, it's 61%. In Japan, it's 54%. In the US, it's surprisingly low at only 30%. I think that's actually lower than what most people probably would have guessed. But the political dissatisfaction everywhere is often a sign that democracy's working. But thinking about the midterms for the year ahead, I think you're going to see some real differences in what the competitive midterms look like for Republicans versus Democrats. Again, this is all part of the data released last week from Pew. It differs greatly by party. So if you look, this is the approve is kind of the darker brown line, and the Republican leaders in Congress, you want to look at that middle graph on the top. That's how do Republicans or people who lean Republican, how do they approve of Republican leaders in Congress? Well, it was 38% in 2014, and now it's 69%. So that's gone up quite a lot. That means if people are approving of their leaders, the Republican primaries are probably going to be much less contested than the Democratic primaries. And that's because if you look at the bottom graph, on the right-hand side, the bottom right, you see how Democrats and people who lean Democratic, how do they approve of Democratic leaders in Congress? In 2014, 67% of Democrats approved of their leaders in Congress. Today, it's 40%. That's going to make for very competitive Democratic primaries, and it's kind of uncertain how we might see things shift in terms of whether the Democratic Party goes further to the left or not. But I'd say that risk is significant given how dissatisfied Democrats and people who lean Democrat are with Democratic leadership in Congress. We'll talk more about midterms next year in some of the calls that I host for MHI, but I wanted to kind of give a tease. The other thing is the 2027 risks, and we got a few risks to work through. Cold War II and the risk of economic amputation are real. 2027 is the 100th anniversary of the People's Liberation Army, and there are significant risks around this. I attended a public luncheon at which Mike Johnson, the Speaker of the House, spoke in Austin back in May, and in the Q&A I asked the question, what is Congress doing about the risks of Cold War II and the fact that we're at risk of increasing risk of a kinetic conflict with China? And his response was, without equivocation or without hesitation, the U.S. intelligence agencies have come into both houses of Congress and run tabletop exercises around 2027 as the year that China wants to take control of Taiwan. Premier Xi has said that 2027 is the year that China wants to take control of Taiwan. No hesitation, no equivocation, 2027, which is 14 months and 2 weeks from now. This is a real and proximate risk. Hopefully, we'll get together, though, in 2028, and you'll say, Jason, nothing happened. And I will say, that is fantastic. And that probably means that the U.S. strategy of containment worked. So let's talk about what's going on. While we just talked about political agitations between the parties in Congress and domestically, the vast majority of Americans view China unfavorably, and this is a bipartisan issue. Y'all know that I met with the first Trump administration and the Biden administration. I was supposed to be in a meeting this past Friday at the White House, but because of the government shutdown, our meetings were canceled. Group I'm in, the Texas Business Leadership Council, there's 100 CEOs affiliated with the Business Roundtable. We advise politicians of both parties on nonpartisan issues. Once a year, we go up to Congress, we meet with congressmen from both parties, one or both of our senators in the administration, whichever administration it is. And between the first Trump administration and the Biden administration, there was no daylight. Y'all remember the first round of Section 232 and 301 tariffs. They came under the Trump administration. Some folks thought the Biden administration would lift them. They did not, and the pressure has risen. And then between the Biden administration and the second Trump administration, the pressures have risen. In my meeting last September with one of the heads of the National Economic Council, and this group of CEOs I'm in, we're at the White House, and the first thing this economist who directly advises the president says, we have the strongest industrial base in the United States since the Vietnam War. She doesn't say since 1972 or 1968. Those of you who've read my book, Cold War II, I mentioned this story in there. We were clearly moving to a wartime footing economy. I think this has played forward, right? We now have a Department of War. You can see this is moving. But I fundamentally believe all of this is to prevent actual conflict. With sanctions, with tariffs, you can ramp things up and down at a moment's notice. If an actual physical conflict starts, you're kind of stuck. So this is Cold War II, not great, right? Nobody wants a Cold War with China, but like Cold War II, greatly preferable to World War III. Let me ask you a question. A couple of you have talked to me about this in the last couple of days. You know, containment was the strategy for the Soviet Union and China that was implemented in 1946 by Truman. Do you know which presidents after Truman during the Cold War followed that policy of containment? Every single one. What's happening now is going to carry forward in future presidencies. This will be the defining conflict of this century. The next president could be the Hamburglar, and they would be pushing this forward. Anyone. anyone at all. Because when the Speaker of the House said, and I heard, there was 40, 50 people there, and he says intelligence agencies come into both houses of Congress, what that means is the intelligence agencies ran war games with politicians in both parties, in both houses of Congress, around 2027. And we see it in a number of areas where there's risk. Supply chain exposures are real. We see it with rare earth minerals. You've seen me share this chart in talks with this group. This is data the IMF released in 2021. I have shared this because I'm a member of the Bretton Woods Committee. I saw this as soon as this came out. I have shared this with you for the last 4 years. Where do these metals come from? We'll make it really easy. I know it's tough to read the words. China and Russia. This is a supply chain exposure. And a lot of the trade stuff that's going on, this is about perceived threats. Canada and Mexico are very unhappy right now. In fact, 68% of Mexican respondents in a recent Pew survey saw the U.S. as the biggest threat. Only 5% thought China was. Canada, 59% of Canadians saw the U.S. as the biggest threat. Only 17% thought China was. This is because the U.S. is clamping down on transshipments. And did anybody here, I'm going to ask the most boring question you've heard all year. Did anybody here read the July 31st executive order on tariffs? Came out of the White House? If you did, you saw Section 3, which, Section 1 is, here's why we're doing tariffs. Section 2 was all the different tariff rates that have been negotiated. And Section 3 was Custom Border Protection and USTR every 6 months are going to reevaluate the supply chains of all goods coming into the U.S. And if we believe that goods are moving through different routes to circumvent tariffs, in other words, if they're goods if you're trying to get stuff in to avoid tariffs, you're going to be hit with a 40% ad valorem tax rate, plus fines, plus fees. I believe it is that third clause that is the sticking point of negotiation with Canada and Mexico. By the way, everyone knew Canada and Mexico were transshipping goods, right? Stuff goes from China to Mexico. You take it out of the made in China box, you put it in the Hetero in Mexico box, and you send it north across the border. Like everybody knew that. Everybody in D.C. has known that. It was going to be part of the USMCA review in 2026 anyway. But I believe the Trump administration is rightly looking at 2026 and going, what comes right after 2026 is 2027, and if we want to avoid kinetic conflict, we need to start building strategic conflict deterrence now. Which leads me to a couple of points I think we need to touch on. One is the dime framework of national power. When people in national security talk about how is a country strong, there's kind of 4 things of power that countries lever: diplomacy, information, military, and economic. And really, for the first time since the Cold War, this administration is really working hard on the economic piece. By the way, at the beginning of the first Cold War, you know what the U.S. did? We got together with a bunch of our allies and came up with a strategy to make sure supply chains remained insular between U.S. allies versus Russia and its allies. But these levers, economic is one of those 4 big things. The economic security piece as a part of national security, as a part of national power, has 2 parts. Economic power, you heard how great our GDP is. Capital stock. Capital stock is all the businesses y'all run, but also infrastructure, airports, highways, oil and gas assets, houses. That's capital stock. Wealth. We have almost $8 trillion in money markets right now, let alone the value of the stock market or record gold prices or everything else. Labor market, it's strong. We have good access to debt markets. But the part where we're weaker is self-sufficiency. Material production, weapons production, dual-use technologies, raw materials, tonnage. And I think there's going to be an increasing focus on medical. You saw it in a bipartisan bill passed on Friday in the Senate to restrict medical investments in China. Bipartisan bill. Words seldom heard these days. And what this means for material handling is we're going to boost self-sufficiency, which means economic mobilization. We're moving to a wartime footing economy. We don't want a war. But if you don't have a wartime economy, if you don't have the industrial production, you don't have the industrial base. This is one of those things that it's better to have and not need than need and not have. This drives my sector outlooks for 2026. You'll notice versus expansion and recession, everything looks really great. I'm sorry, this graph got a little squished in the transfer. But you can see a few things. Everything's on the right, and at the furthest side of the right, e-commerce, non-durable goods, right? That's consumers buying regular stuff. Defense, industrial tech, and metals and mining. By the way, a PDF of this deck will be available for everyone after my talk. Lots of demand for industrial stuff. By the way, shipbuilding, right? The president talked about it at the joint session of Congress back in February. Why? China's biggest navy in the world, it's all in one spot. If you don't have shipbuilding, you can't project deterrence. So that's the 2027 risks. Let's talk about 2034. So I know people are worried about all this kind of stuff. We have a record level of debt at $37 trillion, which is why the Fed's trying to keep inflation under wraps. If inflation expectations skew higher, you're going to have to pay more to finance that debt. But the good news is 20% of U.S. debt is intergovernmental. In other words, 20% of U.S. debt is owned by other parts of the U.S. government, like the Social Security Administration. And if we look, more than 2/3 of U.S. debt is actually held by the U.S. public. And people are worried, well, what happens if we have more debt and then interest rates go up? What happens if treasuries go to 6%? If treasuries go to 6%, people are going to take that $8 trillion in money markets and they're going to back the truck up and they're going to buy it. This is what's going to happen. You can see who owns our debt. China owns under $800 billion, so does the UK. Japan has a little over $1 trillion. But most of the holdings for treasuries by other countries are done to facilitate financial transactions. By the way, if you're wondering why our gold price is at a record level, what kind of triggered it? In January of 2024, last January, for the first time in history, the Bank of International Settlements, which is the central bank of central banks, recognized gold deposits as equal to cash or government treasuries for the first time. The security risks and global geopolitical uncertainty have added to the upside for gold, but that's part of it. The point is, and what I want you to take away from this is, the vast majority of these holdings in U.S. debt are held domestically. And if interest rates go up on this debt, predominantly, we're going to take that money from the higher interest rates, receive it as income, and then spend it. But Social Security does face some existential threats. You know, when it was founded in 1940, there were almost 160 workers per recipient. Today, there's about 2.5 workers per recipient. And the latest data shows Social Security is slated to be insolvent in 2034. But you know what? Medicare was consistently predicted to be insolvent next year. Now it's not. You know why? Because payroll taxes increased. Not a lot, but just a little, and now it's expected to last until 2034. So I predict, in the future, payroll taxes are going to go up. We're not going to see a collapse in these systems. We're not going to see a collapse in the economy. In fact, moving to a more industrial base, moving to a wartime ready economy, or even if, God forbid, we end up in a conflict and we have a wartime economy, that stuff is supportive of GDP. This is resolved with slightly higher payroll taxes. There's also another way to fix it, because I'm sure you've heard me mentioned this in a previous vignette. The grandfather of Social Security, according to the U.S. Social Security website, is Otto von Bismarck. I've included the source there. The Prussian monarchist. He was the blood and iron chancellor, not the bunny rabbits and rainbow chancellor, right? The policy that he implemented was designed to take the winds out of the sails of a rising socialist party. And so they set the benefits age at the age of 70. That was in 1880s Germany when the life expectancy was 40. 30 years spread. As the kids say, that maths. But there was a report out just this week. Germany actually, funnily enough, evaluated its retirement system and determined that if they want it to balance going forward, they need to raise their age of retirement to 73. So, if you wonder what's going to happen to our retirement system, I don't see an economic collapse. We have the strongest economy in the world, and we are going to be investing a lot in our industrial base. Our demographics are much more favorable than Europe, and this economy is hot. We have lots of potential for the Fed to cut rates if things go wrong, right? Right now, interest rates are between 4 and 4.25. There is plenty of room to cut rates. We are reindustrializing as an economy. All of that is quite positive. And then there's the whole AI revolution, which is very strong. And I know there are mixed views on the potential for AI. A recent Pew Research survey, 20% of Americans thought people are making a bigger deal about AI than it is, but 36% think we're making a smaller deal of it than it really is. And I think both of those are right. It just depends what you do with the AI. Let me tell you a story. When I was in grad school for economics back in 2001, I had a professor. She would run a model. It would take 3 days to run the model. The computer would run 3 days. You couldn't touch it, just leave the computer. Today, that model can be run in 3 seconds. But before she would run the model, she would take 3 weeks to clean and prepare the data to make sure the data was good, the columns were correct, the currencies were all appropriate, there were no missing values. And that's part of like a 7-stage process of thinking about data. You ask a question, you scope your project, you collect the data, you clean the data, you analyze the data, then you test it and retest it. Today, everyone's only doing the analyzing part. It'd be one thing if everybody spent 3 weeks preparing their millions of lines of code and then they ran the model in 3 seconds. But what folks are doing is they're just taking the numbers. Oh, I got the numbers. I'm going to AI this. Boop. And they hit the gonculator and it cranks something out. No cleaning the data, no testing the data, right? The potential depends on how you use the data. There's lots of ways you can do it, right? You can use it for spend analysis and go through millions of lines of SAP code. You can look at regional economic data to find opportunities. Or you can use generative AI across various different roles. But with AI, it's really important to trust but verify. The leverage is massive, but you should treat various kinds of generative AI like ChatGPT like a junior analyst that just fell off the turnip truck. Like, you know, if you wouldn't trust a recent college grad their first day and their first real job to hit send on emails without reviewing them, right, then go ahead, just let ChatGPT, like, don't review it, right? But I would recommend you review stuff. Lots of things it can be valuable for. Job postings, sales scripts, RPs, LPs, SOPs, legal drafts only, like please consult your lawyers, form letters, press releases, project plans, emails, the whole thing. And there are AI risks. And people have said, well, AI is going to take all the jobs. Wait a minute. So like, my father and grandfather were CPAs. And I, by a twist of fate, am not. But I remember in the 1980s when they had a small business and Lotus 1-2-3 rolled out. This is the forerunner of Excel. And these were digital spreadsheets. At the time, believe it or not, there were some accountants that said, I don't want to use a computer. I want to continue to keep track of my finances on physical spreadsheets. Can you imagine? those folks either very quickly were out of a job, out of business, or they came around and adopted it. And I think looking forward, AI is going to be like this. Anybody here want to do all of their math and keep track of their budgets and calculate their income statements by hand on a piece of paper? Anybody? No takers, right? I'm working on a book now. It'll be out at the end of the year called The Future After AI. The big idea of the book is we're not going to talk about AI in a while. In the same way, we don't talk about the internet because it's just everywhere. There is one risk, though, based on the survey data. People are concerned that AI will worsen people's ability to connect with each other. And so my recommendation is, on the technology side, there's lots of opportunity for analysis, operational efficiency, productivity, provided you handle the data, prep the data, clean the data, test the data, you run a really good process. But there's also the anti-technology piece, and that's being sure to maintain relationships. In a world where you have infinite abilities to crank out stuff or analyze things, connecting with people and making relationships becomes a much higher value priority. In other words, looking forward, more than ever, your network will be your net worth. That's why conferences like this are really important. We get together, right? Make real connections, make time for people, and be present. Most important thing I could tell anyone to do today. And to follow with some industry-specific strategic recommendations, I would tell you to prepare for an additional domestic industrial demand. It's coming. It is grand strategy at the national level to increase the industrialization of our economy. This is happening. Adopt automation and AI as productivity levers because there aren't enough people to do all the work that needs to be done. De-risk operations for Cold War II risks. What happens if on some given Tuesday you no longer have access to an entire supply chain? And that's why it's really important to strengthen your flexibility and resilience in your organizations, in your operations, and to think about these risks before they become realities. I'll be around for lunch. If you have any questions, I will leave you with what everyone's been waiting for, the disclaimer, everything could be wrong, and my contact info. Thank you very much.